Convertible bonds are compound financial instruments per IAS International Accounting Standard 32 Financial Instruments Presentation. Hello everyone, today we'll talk about convertible bonds, one of the topics tested in FAR ICAEW ACA exam, either in question 1 or question 2. Now let's look into this question. Something similar can be tested in the exam. Let's say start year date is 1st of the 1st 2024. 1st of the 1st 2024 is a start date. ABC Limited issued 20,000 6% £10 convertible bonds at face value. So 20,000 times it by 10, 200k. They raised cash 200k. On 31st of 12, 2027, 4 years. The life of the bond is 4 years. Each bond can be redeemed for cash at par or converted into 2 ordinary shares. So that's the agreement. The interest due on the bonds was paid on 31st of the 12th, 2024. As you can see, the issue date is 1st of January. So payment of interest will be in arrears. The effective interest rate on similar bonds without conversion rights is 10% per annum. So this will be our discount factor. So let's see how we are going to solve this question. Give it a heading convertible bonds. So after giving convertible bonds, bring in the cash flows, bring in discount factor, it's 10%, and then you have your present value. So on 31st of the 12th, 2024, after 1 year since you issued the bond, your cash flow is going to be 6% on that 200k, which is your 12,000. So write 12,000. After writing 12,000, just using the discount factor formula 1 over 1 plus r to the power of n. 1 over 1 plus r, 1 plus 10% will give you 1.1 to the power of 1. You take the discount factor, times it by 12,000, that's going to give you 10,908, your present value. So year 1 is done. Year 2, 31st of the 12th, 2025, again your coupon is 12,000. Discount factor 1 over 1.1 to the power of 2. Discount factor times by 12,000 will give you 9,912. Do again for year 3. The life of the convertible bonds is 4 years. So go up until 2027. So this is 2026. Take 12k. 1 over 1.1 to the power of 3. And your present value is going to be 9012. In the last year, 31st of the 12th, 2027, you will pay 12,000 plus also pay this 200k. So 200k plus 12,000 will give you 212,000. Again, 1 over 1.1 to the power of 4. And that's going to give you 144,796. Just add all these numbers. You will get something 171,462. This is your liability component. This is your liability. Now, how much did you raise? You raised 200k. The balancing figure between 200 and 171,462 is 28,538. That is your equity component, and that's your total. So once you've done this table, all you need is the amortized cost method. So bring in your brought forward, bring in your interest, bring in the payment and bring in the carry forward. So you brought forward, well, on 1st of the 1st 2024 when you issued the bond, the liability 171,462 is coming from here, which we just calculated. So take the liability component, write it underneath the brought forward. Your interest is 10%. The payments of coupon which you were doing was at 6%, so 171,462 times by 10% will give you 17146. And then the payment was again 12,000, and of course payment will be a negative number, and then you're left over with 176,608. Now once you're done with this, you can put that into your non-current liability SFB. You can bring this as a finance cost into your P&L, and this equity component 28,538 will go into the equity SFB. Now this is how you're going to be solving convertible bonds question in a given scenario. This can be tested in either in question number 1 or question number 2. I hope you like this video. If you need more videos like these, please comment. Thank you.